The Middle East conflict is causing energy supply disruptions and price shocks with very different regional market effects. It adds to inflation risk and reinforces our long-held view that we are in a world shaped by supply. For now, we see energy supply disruptions lasting weeks, not months, and don't currently see any reason to push back on current pricing. The conflict is upending recent trends and well-established relationships in global markets. International equities had outperformed US stocks this year, but that leadership has reversed abruptly. Similarly, prices of liquefied natural gas, or LNG, are rocketing upwards in regions that rely heavily on imports, such as Europe, but staying mostly put in the US. Long-term US Treasuries declined, whereas they would often rally and cushion equity market sell-offs in past geopolitical crises. This aligns with our view that we are at risk of an inflationary supply shock rather than a classic demand-driven growth slowdown. This is a disruption at the heart of the global LNG infrastructure, very different from the Europe-centric, pipeline-driven energy crunch of 2022. Back then, LNG prices tightened through competitive bidding and stockpiling. Today, the strain on energy starts at export terminals and shipping posts. We think that Europe and parts of Asia will feel the most strain since they rely on imported LNG for industrial production. These developments fit a pattern we've long observed: geopolitical shocks creating supply constraints in a fragmenting world. Structurally sticky inflation remains the risk if the disruption endures. Against this backdrop, growth-inflation trade-offs become even more acute. That tension is already showing up in rising long-term bond yields and upward pressure on term premia, or the extra compensation that investors demand for holding long-term bonds. Even without a prolonged closure of the Strait of Hormuz, we could see the shock upend the low inflation, low interest rate narrative that has powered markets until recently. The situation remains fluid with real risks. For now, we believe the shock is likely to be short-lived. We see disruptions measured in weeks rather than months. We stay underweight long-term US Treasuries and favor US and Japanese stocks. In Europe, we like select sectors such as financials, pharma, and infrastructure.